name is Ray.
Hi, this is Michael.
And welcome to another episode of Ray's Economics Clue Book. Today we're talking about government policies, how we're now in an open market environment.
Alright.
So, government policy at the most basic level is already a foundational part of our economic knowledge. But we've only talked about it in a theoretically closed economy so far.
Yeah.
With no trade, because trade complicates things.
Yeah.
And so basically, we'll review what we talked about. So let's say economy is an inflationary gap. The Fed hikes the interest rate. Obviously, then interest rate hikes up. Investment decreases. It's more costly now, and obviously, our aggregate demand shifts to the left. This is very basic knowledge to you now, and so it reduces our inflationary gap back to its potential output, and also reduces our price level or inflation.
Okay.
That's very basic stuff. And from a money liquidity preference model, basically how the Fed can increase interest rates. Well, since the money demand curve is upward sloping, if you decrease the money supply or shift the money supply to the left, then your interest rate will naturally increase. This can be done indirectly through, for instance, the Fed increasing the reserve ratio.
Yes.
Although that's not quite as common as a maneuver, but if you increase the reserve ratio, obviously the money multiplier decreases, and so your overall money supply shifts to the left, and thus your interest rate shifts up, and thus your aggregate demand shifts left due to decreased investment.
Oh yeah.
That's in a theoretically closed environment, or other things being equal, because we don't count trade. So what if we do count trade? What if we're more specifically, what if we counted the Forex market, which affects trade?
When we consider the Forex exchange rate, the story becomes a little bit more complicated.
In the face of contractionary fiscal or monetary policy, let's say the price will decrease, obviously, in contractionary monetary policy. This will cause exports to increase as a converse, which will then cause our GDP to increase, or our US dollar to increase as a result.
Yeah, because the demand for U.S. export means demand for U.S. dollar, right?
Yes.
So when people buy more U.S. goods and services, then they demand more U.S. dollars.
So conversely, since the interest rate increases from multiple things, especially from the Fed's monetary policy, the aggregate demand effect reinforced, but the value U.S. dollar increases because demand for the U.S. dollar increases. Why? Not only because of the exports, but also because since our domestic interest rate is now relatively higher than before compared to other countries, we will have more capital inflow into our country from foreign sources.
To take advantage of the higher U.S. dollar interest rates.
It's basically hot money, basically. And so this instance of hot money will then cause our economy to increase because we see an increase in investment. And so what this does is it mitigates the Fed policy's effectiveness of contractionary policy. So the Fed will even have to Fed in this open environment will have to increase interest rates even higher than they would have had to in a closed environment to have the same effect in a closed environment as in a closed environment.
So it will mitigate. Okay, but long-term speaking, the real interest rate will not change, and long-term speaking, the federal policy will still be effective. But short-term speaking, this open economy, the currency effect, will mitigate the domestic policy effectiveness. Okay.
So for our final clues, basically the floating Forex or floating exchange rate or floating Forex paradigm makes domestic policy less effective. So we'll have to take domestic policy, the intensity, or even further to have the same effect. Because it's lessened. However, it might seem negative, but it has its benefits. Otherwise, we wouldn't have it. It insulates against recession or overheating from abroad. So we're less susceptible to recessions from other countries spreading to us. And so there are no import inflation and deflation. But most importantly, it's an OMAC stabilizer. So we already talked about OMAC stabilizers such as unemployment insurance, things like that. Those are like domestic. Those are domestic factors. Now we introduce a new international factor, the Forex market, that also acts as an OMAC stabilizer. How does this work? So let's say the economy is increasing, right? The economy is increasing. The economy is growing, and our U.S. dollar value will subsequently logically increase as well. When this happens, our exports decrease in the short run because they're relatively more expensive. This will prevent the overheating from the growing economy, and since our exports decrease, which affects demand. And conversely, OMAC stabilizer, let's say our economy is decreasing, then our currency decreases.
So basically, if we are in a recession, so our economy is not good, then the currency will automatically depreciating, and which makes the exporter stronger. Which basically automatically kind of like help the economy get out of the recession, because the export is increasing,
and our net exports increase, which increases our GDP or shifts our demand. So from the currency itself,
it becomes a more one more variable, right, into the equation.
Yes.
So in a closed system, we only consider like interest rate, right, fiscal deficit.
Only domestic.
Yes. And now in the open economy, particularly if it's a floating, or maybe we'll call it a free, right?
Yeah.
Free Forex exchange market, okay, then it's a market driven. So there's one more variable we have to consider, which is currency value.
Yes.
Okay, and in the open economy with a floating Forex paradigm, basically it's market driven, then it becomes automatically stabilized, as I just mentioned.
Yeah.
Okay, so that's the benefit to have floating Forex paradigm.
Yes.
Okay, although it might mitigate your domestic policy a little bit in the short run, but long run speaking, it stabilizes the economy, and it insulates from the recessions and overheating from abroad, and it also has no import inflation and deflation because it's automatically market driven, automatically market adjusted, unlike those fixed Forex paradigm.
Yes.
Okay, so we'll talk about more into the microeconomics in the future, and see you guys. Bye bye.